I do feel the need to, just ethically speaking, try to warn people against using overlays, because the typical overlay in the stock market, the financial industry that you'll see, these are people who, through slick marketing techniques, they actually get people to simply leverage up their portfolio, right? That's what ends up happening realistically. So they'll tell people that, hey, I've got this awesome strategy, and you might have a client there that's really interested in, oh, that looks great. I want to add that strategy to my portfolio, but I can't because I've got an entire portfolio of stocks, bonds, real estate, gold, whatever it is. So I don't have room, right? The slick talking marketing guy comes in and says, don't worry, we can just use the available margin in your account. You don't have to sell anything. And we can actually just add the overlay to your account, right? This is what they're going to tell you. And it's going to sound amazing, right? Who wouldn't want to do that? You get to add another strategy and it doesn't actually cost you any capital. It's just an overlay. The problem comes in, and hopefully you know this at this point if you've been watching my live streams, but the vast majority, and I would say nearly all, to be honest, of trading strategies are positively correlated to the stock market and therefore positively correlated to most people's portfolio. So when you add an overlay that has a positive correlation to the stock market, all you're doing is adding leverage. You're not overlaying anything that's going to add long-term performance. You are just leveraging up your positions because they're both positively correlated. So what ends up happening, and I've pointed this out many, many times before, and I say it over and over again, hopefully it's getting through people's head at this point, losses are always more costly than gains are beneficial. What ends up happening in good times, that overlay will add performance and you'll think everything's fine. In bad times, it is just amplifying your losses. And so if you're adding performance in good times and you're increasing your drawdown in bad times, the simple math equation involved here, you are going to cost yourself long-term performance. That's what happens most of the time people use these overlays. They're almost always happy in the beginning when everything's cooperating, and then they nearly always regret it after when they turn around and think, oh, well, all I really did is add leverage, and now my drawdown's twice as big and I didn't sign up for this, right? But by that point, it's too late. So adding an overlay with any positive correlation to the market at all is a non-starter. Don't even think about it.